If you are collecting Social Security right now, or if you are planning to collect it within the next 10 years, the federal government is sitting on a report that directly affects how much money you will receive every single month for the rest of your life. They published it in February of 2026. It has not made major headlines. Your financial advisor probably has not called you about it, and the Social Security Administration is not sending letters. Here's what that report says. The fund that pays your Social Security check, the one you paid into for 30, 40, sometimes 50 years of working, is now projected to run out of money in the year 2032. Not 2035. Not some distant future that feels like someone else's problem. 6 years from today. And when that fund hits zero, federal law requires an immediate, automatic, across-the-board benefit cut of 28%. If your check is $2,000 a month today, you would receive $1,440. That is $560 gone. Every month, $6,720 a year. For the rest of your life. With no warning. No phase-in. No grandfather clause for people already collecting. 1 month you get your full check. The next month, 28% of it is simply gone. But here is the part that should make every person watching this sit up straight. The mistake most retirees will make when they hear this, the natural instinct to protect themselves, is the exact decision that will leave them the most exposed. In the next 20 minutes, I'm going to show you exactly what is in that government report. What a 28% cut would actually mean in real dollars for your specific check. The 5 moves that protect you if Congress does nothing. And the 3 things you should never do in response to this news. Because doing them could permanently reduce what you collect. This information exists. The government just is not rushing to make sure you have it. That is what this channel is here to change. My name is James Whitaker. I am an enrolled agent, which means I am federally licensed to represent taxpayers directly before the Internal Revenue Service and to advise clients on retirement income strategy. The conversation I am about to have with you is the same one I have had with every single client who has walked into my office in the last 3 months asking some version of the same question. Is my Social Security safe? The honest answer is, it depends entirely on what you do next. I want to tell you about a client. I am going to call her Dorothy. Dorothy is 71 years old. She lives outside of Columbus, Ohio. She was a registered nurse for 38 years. She raised 3 kids. She paid into Social Security every paycheck from 1974 until she retired in 2017. Her monthly benefit is $2,240. That check, combined with a small pension from her hospital, is how Dorothy pays her mortgage, her car insurance, her medications, and her groceries. She does not have a large investment portfolio. She did not have the kind of career where stock options and 401k matches stacked up. She has her home, she has her pension, and she has Social Security. When Dorothy came in to see me after reading a headline about the Social Security Trust Fund, she asked me one question. She said, "Is this real? Or is this like the things they say on the news to scare people?" I told her it is real, and I told her exactly what I'm about to tell you. The Congressional Budget Office, that is the nonpartisan federal agency whose entire job is to score the financial reality of government programs with no political spin, published its updated 10-year budget outlook in February of 2026. That report moved the Social Security, Old Age and Survivors Insurance Trust Fund depletion date from 2033 to 2032. 1 year earlier than estimated just 12 months ago. This is the second consecutive year the date has moved closer. Dorothy sat across from me and did the math herself. "If my check gets cut 28%, she said, I lose $627 a month." She would not be able to keep her house. Dorothy is not a financial statistic. She is a real person who spent nearly 4 decades as a nurse keeping other people alive. And the system she was promised is sitting on a funding shortfall that the people responsible for fixing it have not fixed. She is not alone. There are 72 million Americans in her exact situation right now, and most of them have no idea this report exists. Let me explain exactly how this works because the details matter. Social Security retirement benefits are paid out of something called the Old Age and Survivors Insurance Trust Fund, OASI for short. That trust fund is built from 2 sources. First, payroll taxes. Every time you received a paycheck during your working years, 6.2% was withheld for Social Security, and your employer matched it with another 6.2%. That money flows into the OASI trust fund. Second, interest. The trust fund holds U.S. Treasury bonds and earns interest on the surplus it has accumulated over decades. Here is where the math breaks down. In 2010, the number of Americans collecting Social Security crossed a tipping point. The baby boom generation, 76 million people born between 1946 and 1964, began retiring in enormous numbers. The ratio of workers paying in to retirees collecting shifted. In 1960, there were 5 workers supporting every one retiree. Today, there are roughly 2.7 workers for every retiree. By 2035, that number drops to 2.3. Less money coming in, more money going out. The trust fund is drawing down. The Congressional Budget Office projects the trust fund will be exhausted in fiscal year 2032. The word exhausted is precise. It does not mean Social Security disappears. It means the trust fund reserve hits zero. At that point, Social Security can only pay benefits out of incoming payroll taxes. And incoming payroll taxes in 2032 are projected to cover approximately 72 cents of every dollar owed. That 28-cent gap is what gets cut from your check. Under current law, specifically the Social Security Act as it is written today, there is no provision for the federal government to borrow money to make up that shortfall. Benefits are automatically reduced to match incoming revenue. This is not a new political threat. This is not a partisan talking point. It is math written into federal law, confirmed by a nonpartisan agency in a February 2026 report that most Americans never saw. Now, I want to stop here and say something clearly because I know what some of you are thinking. You are thinking, Congress will fix this before it happens. And you might be right. Congress has fixed Social Security before. In 1983, the program was months away from missing payments when Congress passed a bipartisan rescue package that raised the full retirement age, expanded covered workers, and made benefits partially taxable. That is possible again. But here is what I need you to understand. The 1983 fix happened because the crisis was immediate. The trust fund was running out in 3 months. There was no choice but to act. In 2026, the fund runs out in 6 years. That is far enough away that Congress can continue doing what Congress has done for the last decade. Nothing. Every year they delay is a year the math gets harder to fix. And every year you wait to protect yourself based on the assumption that Congress will act is a year of exposure you cannot get back. I'm not telling you to assume the worst. I am telling you to prepare for it, because the people who prepare are the ones who are not blindsided. When retirees hear this news, they tend to make one of 3 mistakes, and I have seen each of them cause real damage. Mistake number 1, waiting to file for Social Security. I speak to retirees every single week who are holding off on filing because they heard that delaying benefits increases their monthly check by 8% per year past full retirement age. That is true. Delay from 66 to 70, and you receive 32% more per month. But here is what the delay calculation almost never accounts for. If the trust fund is depleted in 2032 and benefits are cut 28%, the higher delayed benefit you were planning on also gets cut 28%. You waited 4 years to collect 32% more, and then 28% of that larger number disappears on the same day it disappears for everyone else. The break-even point on delaying benefits, the age at which the larger monthly check finally surpasses the total you would have collected by filing earlier, is typically between age 80 and 83, assuming no benefit cut. With a potential 28% reduction entering the picture in 2032, that calculus changes significantly for anyone who is currently 62 to 68 years old. I am not telling you to file early. I am telling you that always delay is not the automatic answer it used to be. And anyone who gives you that advice without accounting for the 2032 scenario is working off incomplete information. Mistake number 2, assuming Medicare is separate. The Medicare Part B premium is deducted directly from your Social Security check. In 2026, that premium is $202.90 per month. That is a 9.7% increase from last year, and it comes off the top of your Social Security payment before you ever see it. If your benefit is cut 28% in 2032 and Medicare premiums have continued rising, and they will, the net reduction to the check that actually lands in your account will be larger than 28%. Most retirees calculate their Social Security exposure in isolation. Medicare and Social Security are financially connected, and any plan that does not account for both is incomplete. Mistake number 3. Keeping retirement income concentrated in one source. The retirees I am most concerned about are the ones whose retirement budget depends on Social Security for 60%, 70%, or 80% of their monthly income. A 28% cut to a check that covers 70% of your expenses does not mean a 28% reduction in your standard of living. It means a 20% reduction in your total monthly income. For someone on a fixed budget with no other income sources to draw on, that is not an inconvenience. That is a crisis. The time to fix that concentration is before 2032, not after. Let me make this concrete. The average Social Security retirement benefit in 2026 is approximately $1,976 per month. A 28% reduction takes that to $1,423 per month. That is $553 less every month, $6,636 less per year. Over a 10-year retirement, that is $66,360 in lost income. With no adjustment for the cost of living increases, you would have also lost. Now let us look at higher earners. The maximum Social Security benefit at full retirement age in 2026 is $3,822 per month. A 28% cut takes that to $2,752 per month, $1,070 per month. Gone, $12,840 per year, and at the low end. The minimum Social Security benefit for a long career worker in 2026 is approximately $1,033 per month. A 28% cut takes that to $744 per month, $289 less a month for someone already living on the absolute minimum. For Dorothy, my client, the nurse who paid in for 38 years, her $2,240 becomes $1,613, $627 per month, every month, for the rest of her life. These are not hypothetical numbers. They are the direct mathematical output of the Congressional Budget Office's February 2026 report applied to current benefit levels. Write your own number down. Take your current benefit or your projected benefit. Multiply it by 0.72. That is what federal law currently requires the Social Security Administration to pay you if the trust fund is depleted and Congress has not acted. Here is what I tell every client who sits across from me after hearing this for the first time. There are 5 moves you can make right now this year that change your exposure entirely. None of them require you to be wealthy. All of them are available to any retiree. Move number 1. Run your personal break-even on Social Security filing age today. Not tomorrow. Not when you feel ready. Today. The Social Security Administration has an online calculator at ssa.gov that shows you your projected benefit at age 62, full retirement age, and 70. Pull those numbers, then factor in the 2032 scenario. If you are 63 or 64 right now, the window to claim before the first potential cuts arrive is still open. If you are 68 and have not filed, the calculus is different than it was 3 years ago. Get the specific numbers for your specific situation. Do not rely on general advice. General advice does not account for your benefit amount, your health history, your spouse's benefit, or the 2032 timeline. Your situation is specific. Your decision should be too. Move number 2. Open one high-yield savings account and fund it this month. The single most practical thing any retiree can do to reduce dependence on Social Security is to build a cash reserve that can absorb a benefit reduction without triggering a lifestyle crisis. High-yield savings accounts at online banks, Ally, Marcus, by Goldman Sachs, Discover, Capital One 360, are currently paying between 3.5% and 4.5% annual interest. That is 10 times what the average local bank pays on the same deposit with identical FDIC insurance. If a 28% benefit cut is coming in 2032 and you start building a $20,000 to $30,000 buffer this year, that reserve earns you $700 to $1,350 per year in interest while it waits. When and if the cut arrives, you have 18 to 24 months of the income difference sitting ready. You are not scrambling. You are prepared. Move number 3. Claim the $6,000 senior tax deduction before it expires. This is a piece of news almost nobody is talking about. For the 2026 tax year, the federal government added a new $6,000 deduction available to eligible taxpayers age 65 and older. If you qualify, this directly reduces your taxable income, which means less of your Social Security benefit gets taxed. Here is why this matters in the context of the 2032 concern. Up to 85% of your Social Security benefit can be subject to federal income tax if your combined income crosses $34,000 for a single filer or $44,000 for a married couple. That taxation eats into the check before you spend it. The $6,000 deduction can push you back below those thresholds. That is real money, potentially $1,000 to $1,800 back in your pocket every year, from a provision most tax preparers are not proactively flagging for their senior clients. Talk to a tax professional about whether you qualify. The IRS website has the current income thresholds. Do not let this one expire unused. Move number 4. Diversify at least one additional income source before 2030. I am not asking you to become an investor. I am not telling you to put money into something you do not understand. I am asking you to identify one income source that does not depend on Social Security. For some people, that is Treasury bills. Short-term U.S. government bonds currently paying between 4% and 4.5%, purchasable directly at treasurydirect.gov in amounts as small as $100, with full faith and credit of the United States government behind them. For some people, that is a part-time income. Even $500 a month from something you enjoy reduces your Social Security dependence by 25%. For some people, it is a deferred annuity purchased in the next 2 to 3 years while rates are still favorable. The specific vehicle matters less than the principal. Every dollar of guaranteed monthly income that does not come from Social Security is a dollar that is not exposed to a 2032 cut. Build even one additional pillar before 2030, and your exposure drops significantly. Move number 5. Contact your 2 U.S. senators and your House representative in writing. I know some of you are skeptical of this one. I understand that. But I want to be direct with you. The 1983 Social Security rescue happened because older Americans made noise. The American Association of Retired Persons had 9 million members generating letters and phone calls. Congressional offices felt it. Politicians who were previously unwilling to touch Social Security found the political will to fix it because they were afraid of losing their seats. 72 million Americans are currently collecting Social Security or will be within 5 years. That is not a minority. That is the largest single voting bloc in the United States. A letter to your senator takes 15 minutes. It goes into a tracking database. Every letter, every call, every constituent contact gets tallied. When the number of contacts on Social Security solvency crosses certain thresholds, it moves up the priority list. You are not powerless here, but you have to participate. The link to find your representatives is house.gov and senate.gov. Both sites let you look up your specific representatives by zip code and contact them in under 5 minutes. Let me answer the 3 questions that are already in the comments of every video like this one. What if I am already 75 or 80? Is it too late? It is not too late. The high-yield savings account, the $6,000 tax deduction, the Treasury bill ladder, all of those are available to you today regardless of age. The filing strategy question is behind you, but the financial protection moves are not. Will Social Security really be allowed to cut benefits? Won't there be a legal challenge? The Supreme Court has consistently held that Congress has the authority to modify Social Security benefit levels. The program is not a contract. It is a federal statute. Congress writes it, and Congress can change it in either direction. A benefit cut in 2032 would not be a policy choice. It would be the automatic legal consequence of the trust fund hitting 0 under existing law. That said, Congress absolutely has the authority to change existing law before 2032. A benefit cut is not inevitable, but it is the current legal trajectory if nothing changes. Should I stop paying attention to this and just enjoy my retirement? That is your choice to make. But I want you to make it with accurate information. A 28% reduction to a fixed income in retirement is not something most people can absorb without significant life changes. The retirees I worry most about are the ones who heard this was coming, assumed it would be handled, and took no protective action. Dorothy did not take that approach. 2 months after she sat in my office, she opened a high-yield savings account and started moving money into it from her local bank. She contacted both of her Ohio senators. She had a separate conversation with her tax preparer about the $6,000 deduction. She told me that making those 3 moves did not make the problem disappear, but it made her feel less like something was happening to her and more like she was doing something about it. That is the difference between being prepared and being blindsided. Let me leave you with the one number that matters more than any other in this video: 72%. That is what the trust fund is projected to cover in 2032 if Congress takes no action. 72 cents of every dollar you are currently owed. Your job between now and then is to make sure that 28% gap does not determine whether you can pay your bills. The government published this information. It is in a public report available to anyone. But publishing a report and making sure the people it affects actually understand it are 2 very different things. That is what this channel is here to do. If you know someone who is retired or who is planning to retire in the next 10 years, send them this video, not to scare them, to give them time to do something about it. Time is the one thing that runs out before the money does. I will see you in the next one.